Now I'm really excited to introduce us to our expert for the day. We have Lindsay Chung. Lindsay is a program manager at Accion Opportunity Fund, and she has more than 12 years of experience in the accounting and finance industry. Lindsay has worked with hundreds of small business owners across the country, more than 20 different industries, from startups to established businesses. She has helped businesses understand their credit and ways to improve it, along with advising them on how to manage their cash flow, analyze their financials, and improve their bookkeeping practices. Lindsay first realized her passion for economic empowerment while proudly serving as a Peace Corps volunteer in Botswana. She has a Bachelor's of Science in Business Administration, Accounting, and Finance from the University of Colorado and currently lives in Denver. Hey, Lindsay.
Hi, Brittany. Thank you so much for inviting me today. I really appreciate it. And I want to thank each and every one of you for joining us. Credit is such an important topic for small business owners and something that can be kind of sensitive. You know, as a small business owners, I think we oftentimes have ups and downs in our business. And so it can be really hard to maintain a great credit score, but it's a very important tool in growing our business. And so today we'll go over the importance of credit. Let's start with personal credit. So with personal credit, there's two big components. One is your credit score, also known as your FICO score. And on the right here, we have an example of kind of generally what's considered bad to excellent credit. And so there's quite a range there, but that may give you an idea about where you kind of line up. There's three large bureaus, and so that's TransUnion, Equifax, and Experian. And they all use similar models, but you could have a different score with each an individual one because they do have different logarithms and things that they look at when evaluating your credit. On your credit report, it will have more detailed information. It'll show exactly, you know, if you were late, when you were late, the details about the different types of accounts, if it was paid in full or if it's in collections, if you had a bankruptcy. All this information will be included on your full personal credit report. You have access to your personal credit report from all three bureaus for free every year under the Fair Credit Reporting Act. You just have to go to annualcreditreport.com and then you pull them for each individual credit bureau there. So typically these don't have scores on them. They will have what's on your credit report. And this is good practice to check this every year because there's a large number of mistakes that may be on our credit report. So just making sure that everybody's reporting it correctly, that your address is correct, and everything of that sort can really make sure that everything is accurately reflected on your credit. And if not, you know, it's important to dispute those errors and get everything corrected. If you want an idea of your score, you could go to creditkarma.com. They do a Vantage score, so it's a little different than a FICO score, but it should give you a good idea of what range you're in. And it also has a nice breakdown of like ways that you can improve different pieces of your credit. So this gives us a good idea of how our credit score is calculated. So the most important thing is your payment history. So paying things on time. And so this looks at how often you were late, how many times you were late. A good key is that oftentimes they don't report until you've hit that 30, 60, or 90-day mark. So if you know you can't, you know, manage all your bills this month and pay them exactly on time, try to do it before it hits this 30-day late mark so that it doesn't show up on your credit as late. So keeping this current is great. And if you did have some bumps, you paid things 30, 60, or 90 days late, then the longer it's been since you've had those late payments, the less of an impact that it will have on your credit. So if you did have some late payments recently, sometimes it's just kind of waiting until there's some distance between when you're applying for credit and when those late payments actually occurred. The amount owed is another really important part. So they typically say it's not a hard and fast rule, but they say to try to keep your credit utilization, so the amount of credit you use compared to the amount that it's available to you, between less than 25 or 30%. So if you, I see this really often for small business owners. They maybe don't have access to credit very early in their business cycle. And so they may use personal credit cards or credit cards to really build up their business. And so what happens is they max out their credit cards, and by the time it's time to get credit or to really, get that capital to infuse into your business, your credit score is tanked because it's such a large portion of your credit score. And it may be difficult to get capital. And it can also be difficult to get capital if you're doing it on your personal cards, because oftentimes lenders don't want to refinance transactions on personal credit cards. So try to keep away from those credit cards. Try to look for capital before you need to. If you get a loan, those tend to be at a more competitive interest rate than you would get on your credit card. Something that can be helpful with this, since it's a large portion, it can be one of the easier things to adjust, just paying down those credit cards. And even if you just pay your credit card a while before it's due, that could reduce your balance. So by the time they report to the credit bureaus, your credit utilization's a little lower. So there's a few things that you can do to kind of adjust and maybe improve your chances a little more if you know that you're going to apply for credit soon. The next most important is your credit history. And so they'll look at the length of time. They just want to see that you've been able to manage credit for a long period of time. And so, if you did get a credit card in high school or something and you don't use it anymore, I encourage you to still keep it especially if there's no annual fee or anything of that sort. And then you can put an automatic transaction through there. So if it's Netflix, just put the automatic transaction through there. And then auto pay it every month. And so it's something you don't really have to worry about. And if you don't like having credit cards around, you can also, chop up your credit card. It'll still report as long as you're doing those auto payments. And so that may help improve your credit history. Something else that could improve it, if you don't have much credit history at all and you have what we call a thin credit profile, so you maybe don't have many transactions and don't have a long amount of history, then you could see if one of your friends or family would add you as an authorized user on one of their cards, and then their credit history for time will report on your credit report. So that's a good way to kind of move that up a little bit quicker. Another important thing is types of credit. So in addition to the time, they just want to see that you've managed a lot of different types of credit. So that may be credit cards and maybe a car loan, just as many different kinds of credit that you can really helps show that you can pay on all types of different debt. And then there's also new credit. So every time you authorize somebody to pull your credit, it will bring down your credit as long as it's a hard pull. And so you want to be really careful about that. That will also stay on your credit report for about 2 years. So some lenders get nervous when they see a lot of inquiries on your credit report. And that may be a reason for a decline, especially on the business side. There's no shopping window like on the consumer side. So on the consumer side, you usually have a certain period of time where you can shop around, especially when you're buying a house or a car. It allows you to do this to find the best interest rate, but it's not the same for business loans. So make sure you're talking to that lender, understanding whether it's a soft pull that doesn't hurt your credit or a hard pull, before you go ahead and move forward. And I think the best policy is really to be upfront. If you know that you had, a bankruptcy 2 years ago, tell them before you apply. They're going to find out one way or the other. And I think being upfront really helps. It'll help save you time. Some lenders do have policies that you need to have a bankruptcy that's been discharged for 3 years or 7 years. And so knowing upfront whether you would be a good fit may help reduce the number of inquiries you have and help save you time. There are great organizations out there that help small businesses that do have bumps on their credit. And so finding one of them may be a better investment of your time. So best practices for building strong personal credit is obviously, to pay on time if you can. if you can't, try to pay before that 30, 60, or 90-day mark. Pay the full amount whenever possible. Ideally, in a perfect world, we would be able to, just pay our credit cards off right away. If that's not possible, just try to get your minimums in before that mark, and that will really help. Aim to keep your balances low. As I mentioned, 30% or less is ideal out of the total credit that's available to you. And then try to establish multiple trade lines. Never take out more than you can afford. Make sure that you're being as responsible as you can with your credit, and then avoid getting too many inquiries. And some things just take time. If we had some recent late payments, generally, if we actually did miss those payments, there's not a ton that we can always do about that. And so sometimes it just takes time for those to fall off, and same with inquiries and things of that sort.
Thank you so much, Lindsay. I know that was rapid fire. And thank you everyone for coming. So we have those free coaching calls that you can get on for many things, but access to capital is kind of our topic here today. We hope you feel more prepared to tackle some of this and repair your business credit, and we will see you all in the next one. Thank you everyone.